Welcome, everybody. Thank you so much for joining us today. My name is Denise Myers. I'm the Director of Education at RHA, and we are here today doing our weekly live webinar class. This week, we're talking about rental market update, and this is coming from one of our longtime members who is a commercial real estate broker and also has been involved in the development of commercial analytics, although I'm not sure how involved you are still in that, Candice, but I'm sure that's where some of this data is coming from. But she's got a lot of great data to share with us about what's going on in the rental market industry right now. So if you have any questions during this session, please use the Q&A button. I'm chatting to you right now with a link to the materials that you can download. And if you have any issues, technical issues, you can use the chat to chat with me. But otherwise, if you could use Q&A window to ask questions for the instructor, that would be fantastic. So with that, I'd like to introduce you to our instructor. This is Candice Chevaillier. She's, as I said, been involved with the organization for quite some time. She spent a long time on our board, but I think just not maybe in the last year or so since you got off serving on our board, but maybe she'll be back again. But she still is a volunteer teacher and speaker for many of our events. And I know you're very busy right now, Candice, so we want to thank you very much for sharing with us your time today.
You bet. Thank you for that introduction. So let's see, we'll launch into it. My name is Candice Chevaillier, and I am a principal at Lee & Associates Commercial Real Estate Services on the Northwest multifamily team. And I've been selling apartment buildings for over 20 years now and focused specifically on kind of the Seattle in-city market. And it's true, I've been involved in some research and data collection sort of across the region. And that's been a really interesting project to be a part of because, you know, what we're going to go through today is a lot of information and data about kind of what's happening in our region and then how that translates into what's happening in the market. So let's see, we can go to the agenda slide and go through basically, what we'll go through today is an overview of kind of the economic demand side, some development and supply and construction information, and then move into sort of vacancy trends, a rent analysis, valuation and sales, and then a little bit about the regulatory environment if we have time, just because it's another kind of moving part of the whole equation. And then some recommendations going forward, just given where we are in the market. So let's see, we can go to launch right into economic demand. And most of the data that I'm presenting to you here is from a subscription service called CoStar. They're considered kind of the gold standard nationally for apartment data or commercial real estate data generally, and they have very good kind of current analytics. So I grabbed some of those for this presentation so that you'd really feel like you have some up-to-date information. So with this slide, we basically are looking at net population change, and this is specific to the Seattle MSA. So that is, you know, King County, Pierce, Snohomish, sort of that larger, it's called a market statistical area. And so I just wanted to kind of give you a reference point for where this data is referring to. And so you can see through the pandemic, we had sort of this population loss, and then it really jumped back up in 2021, which is sort of a fascinating year, kind of 2021 into 2022, really strong population change and growth in our region, mostly due to in-migration. So from that standpoint, we also have the next slide kind of goes into population growth. So the previous one was change. Now we're looking at growth, and you can see kind of that dip sort of culminating at the midpoint in 2021, and then how we're sort of climbing back out of that that trough of population, a falling population back onto kind of a more of a normal trajectory. And then 2023, which is at this time of year, we're thinking a lot about that, is what's going to happen in 2023, right? So we see, from a forecasting standpoint, obviously the further out we get in the future, the less accurate or specific to data that those forecasts can be, but we have to have some kind of concept of the future. So generally speaking, you'll see most forecasts kind of get conservative as they get further out, which is kind of a best practice. And so from that standpoint, we're seeing that the population is expected to kind of peak in, call it end of 2023, early 2024, and then level out. So we'll watch this, because the reason we care about economic demand is it's an indicator of rental demand, right? So we can go to the next slide here. And so job growth is another piece, which is important at this juncture. So, over the long term, Seattle has had one of the better performing US metros, and the number of jobs here increased 5.6% in the last year, above kind of the national benchmark. And so over the past decade, the Seattle region really outperformed the national market, with the total number of jobs growing by 22.5% as compared with the national average. So from that standpoint, let's see, we can go to the next slide. And this is sort of net employment change. And what we've seen here is, obviously you see that the bars going down. This makes economists crazy when their bars don't line up anymore, and you can't see this nice flow. We have what happened during the pandemic. We saw a real surge in employment, and now we're starting to see that taper off, and that's playing out right now in our market, right? Because we've started to see a contraction in the employment landscape with rounds of layoffs in tech, construction, and real estate. So we're already seeing the effect of the interest rate growth kind of rippling through the market in these ways. And so, if the objective of the Fed was to slow the economy down, that is happening. Obviously we've heard sort of rounds of layoffs. Meta with 11,000 jobs, 8,000 in the Seattle area. Zillow, I think we're at laying off 300 at this point. Twitter is about 200, a little over 200. Redfin is at 862, Flyhomes 280, Amazon 10,000. That was just announced on Friday. And I think Microsoft is doing some contraction as well. So we are seeing precisely what the rise in interest rates was intended to do, which is slow the economy, and that's manifesting itself in some job loss. So you can see that kind of playing out through the course of 2023 and early 2024. And that's when we expect that kind of reversal and start to see employment leveling off in terms of demand. So we can go to the next slide. This is an interesting concept. One of our kind of go-to resources for apartment market dynamics is actually my partner at Commercial Analytics, Brian O'Connor, and he publishes a market report of particular interest because he's looking at the demand ratios between the east side and the Seattle market, and obviously north and south as well. And there's a lot of kind of urban legend around sort of everyone leaving Seattle and everyone going to the east side, and that's forever going to be the case. And it's always nice to look at the data, and the data does not suggest that. Actually, it's hovered around kind of that 60% capture rate. You can see in this table, you've got demand for unit demand, and then the capture rate, which markets are actually capturing that those units. And I think this is fascinating to just see where people are kind of moving. And if you're thinking as an investor would, where are the opportunities? And so, looking at that 60%, that pretty even demand across the board for Seattle, whereas It spiked a little bit in 2022 towards the east side, but then actually came back and contracted a bit as you look all the way out to 2024 for the east side. So it's just interesting, right? And then, you see South End and Snohomish, are people going north and south? You can see that stays fairly consistent, a little bit more driving towards the South End and Snohomish out of east side, but you can see that that Seattle actually stays pretty even keel. So I just thought that this was an interesting table to present because it does kind of add data to that sort of maybe an urban legend narrative that may not be quite true. So from that standpoint, looking at development, now we're kind of moving into the supply side, right? We've talked about demand, what's happening on the demand side. Now this is the supply side. So the trick here is we definitely have sort of a lot of new supply that's been delivering almost slowly into the market over the last several years. The 2020 pandemic hit right as we were in kind of this surge of the development and delivery of units, new units. But what was challenging is, being able to get that construction actually completed was really difficult. So it's kind of stretched out our supply delivery in the market. That actually can be a benefit because it's better than just having a ton of units all hit at one time. And what we're expecting is actually a little bit of a little bit of softening in terms of the amount of deliveries. I have a couple of sources of data. This particular source shows pretty consistent delivery and then a dip in 2025. I actually think that it's more like we're going to see not a lot of deliveries in 2023. A lot of those will push to 2024, and then 2025 will start to even out a little bit. We still have very much a deficit of new units coming to the market. I think that's important to recognize. Downtown and Lake Union submarket saw a wave of construction delivering kind of this year, exceeding demand to a certain extent. So we tend to see a little bit higher vacancy in those particular neighborhoods. And then we can kind of go next to vacancy trends. So now we're going to start digging into the apartment part of the presentation, not just the economic side and the construction side. So on the vacancy side, there's a lot to unpack on this slide, but I like this visual because it shows kind of the interrelationships between absorption, the net deliveries, that's the supply, absorption is the demand, and then what that does to the vacancy rate, which is almost like a byproduct of that supply and demand cycle. So in blue, you can see the deliveries, which is essentially that supply. And then in orange, you can see the absorption, the demand. If you layer those together, you can see that that apartment supply is going to exceed the demand in the next couple of years. But then the inflection point comes right in the end of 2024, where you start to see supply and demand kind of evened out. And typically the reason why we care about that inflection point is that's when rent growth is going to be the most solid, right? Assuming kind of a normal demand, economic demand for property, that's where we're going to see an opportunity for rent growth. And also, as you see that vacancy rate float down, again, that's a byproduct of showing that there's more renters than there are units, right? Okay, so next slide. And then we've got these vacancy trends. And again, we're expecting vacancy to rise sort of through the end of 2024. This kind of gets to my point about expecting not that much new inventory in 2023. And then we start to see some deliveries of projects that basically started going through the entitlement process, call it right after COVID. So we'll see those projects kind of manifest themselves towards middle end of 2024. And so we expect those to create a little bit of vacancy in the market as well. Now, we're expecting rates to float up to call it 7%. 5% is considered a market in equilibrium. So it just means that that tends to be a little bit of a drag on potential rent growth. Now, the other interesting thing that I'll mention on this slide is Seattle has a very seasonal rental market. It's not really showing here because this is kind of showing sort of quarterly rent data for vacancy, but typically you can get, and I've heard different opinions from different property managers, but if you're timing your leases for kind of the summer months versus the winter months, you can tend to get about $200 more if rented in the spring or summer as opposed to the fall or winter. And that just tends to be, there's just a little bit more rental movement and activity from tenants during that time period. So something to think about as you're thinking about your leasing cycle from that standpoint. So let's see, let's go to the vacancy trends. So this is an interesting slide because it really shows the higher vacancy rates on the newer buildings. And I think this is really important as well, because there's a perception that sort of the vacancy rate in a market is going to predict how your particular vacancy rate will be. And there's a pretty big difference of a building that's in lease up, that's all new construction, that's luxury, that has all the bells and whistles, and they're trying to lease up their unit. They're going to have vacancy. And these tend to be, this vacancy rate tends to show stabilized assets, right? Ones that are already leased up entirely. But those buildings are going to generally have slightly higher vacancy rates than maybe the smaller, older, less expensive properties that are maybe sprinkled throughout the neighborhoods versus like sort of a large, call it Belltown project. And so what you're seeing in the data here, and what I anecdotally hear from investors, is these smaller buildings, older buildings, their vacancy rates are really quite low, and that's sort of that's the difference between these two trajectories. So from that standpoint, if you've got kind of older units, you can afford to be, or your rents can be more affordable. And hence that tranche of the market tends to have a little bit stronger vacancy. So just wanted to mention that. And then let's go ahead and go to the next slide. And this one has to do with vacancy by bedroom. And the reason that I'm showing this is I think that's sort of it's showing you that the larger buildings are, I should say the larger units are a little bit more desirable right now. So our vacancy rate, you can see it almost is in reverse order of the studios are, kind of peaking at that higher vacancy rate. And then it falls in line 1 bedrooms and 2 bedrooms and 3 bedrooms. There just aren't a lot of 2 and 3 bedroom units. And especially with a sense that we're going to be some sort of hybrid model, some sort of working from home, a little bit on the longer term basis, that's what you're seeing in the demand for units is this a little bit larger units in general. So that's something that I think is interesting, starting to come back together. You can kind of see that. And this has to do with the rental market tightening quite a bit over the last year. 2021 was a really strong year for renting and rent growth. So next slide.
Candice, before we move on, so a lot of our members have own not in this space, not in the commercial space, but in the single family homes. Would you say that the vacancy rate for a 3-bedroom apartment would be similar to single family homes?
I think that's a good question. I really look at single family home rentals almost completely different than apartments, because what we're seeing with those is we're seeing a few things. One, typically in the last couple of years, there has been an incredible run up in value of those rentals. As if they were put on the market for sale, the likelihood is they would not continue as rentals. They would be purchased. Now, the reason I kind of paused is with the increase in interest rates, that is putting the brakes on that first-time home buyer or the typical maybe buyer of that starter rental home. And that is going to be a little bit more out of reach for that buyer, meaning you may see people deciding to kind of hold and rent their single family homes versus selling and immediately getting a for sale buyer, right?
Right.
So that may actually increase the availability of single family homes as rentals. I think this is healthy because, as I mentioned before, a lot of the new development of apartment buildings are simply ones, studios, CDUs, really small units. They're not typically building these 3-bedroom, 2-bedroom, 2-bath units. So if you're able to find a house that is that unit type, that's what you see these low vacancy rates, because you know, there's just not that many options for, call it the 3 roommates living together, the small family, especially if they want to be in an urban environment. There's just not that much choice. So we may see a premium for those kinds of units. Even
so you'd say the vacancy rate's even lower than for the 3-bedroom apartment.
Well, that's a fast way to put it.
No, but it's good to hear the reasons behind it and the background. So
yeah, no, it's really dynamic. And I think this, you know, I don't think that that's really been communicated as a byproduct of raising interest rates, right? We're trying to slow the economy, but it's taking the affordability of being a home buyer. It's kicking that can down the road, down the road for a lot of families that might have been right on the edge of
on the edge of being able to buy.
And now they're looking at renting for the foreseeable future, at least for the next couple of years. And the other element that's happening on the for sale home buyer market is with these higher rates, you see people who refinance their properties. They're not going to put those things on the market. They're not going to lose that great debt. You know, there's a lot of people in the market right now that refinanced over the last couple of years, and they're all sitting at 3.5% for 30 years interest rates. So they're not going to sell that building because the debt's so good. You know, if they took that house and decided to buy one for the same amount next door with a new loan, they probably would be paying 7.5%. That's double just the interest. So
makes sense.
Fascinating. It's fun when it's interactive. So let's see, I'll kind of get through this and then maybe we can do a longer Q&A section because those are always fun. So rental analysis, this is showing we do have some softening rents. And really what it is it's the deceleration in the rate of rental growth. Okay, so that's something that's kind of important. That doesn't mean rents are dropping per se. It means that they're rising more slowly. In fact, there was just an article on Friday, and the headline was "Rents are going down," and it was this slide. And so I pulled the slide to show, look, downtown Seattle and Issaquah, as a matter of fact, are the only 2 markets that you're seeing. You know, and actually, what is it for one? Let's see, it's a little bit below 0, right? Meaning they're sliding back a little bit. And this doesn't surprise me given kind of the tech layoff, you know, elements and things like that. We are going to see a little bit of softening in kind of that downtown market. But if you look at most of the other markets, they're still growing. It's just a decrease in the rate of growth. So I just think that's an important point as you start to see some of the media coming out in the next, you know, year or so about what's happening in the rental market. So if we look at the next slide, this starts to kind of tell a little bit more of a story on what we're seeing from a rent average standpoint by neighborhood. So this is specifically King County. My next slide is for Snohomish and Pierce. So hang on if you're interested in that market. So what we're doing here is just kind of breaking it down by neighborhood. I'm not going to go into all the numbers here, but if you own in these different markets, you're going to automatically kind of go to your market and think about those numbers. You can see a vacancy rate here. You see that downtown, South Lake Union, 10%. Again, that may be capturing some of the lease up activity that's taking a little bit longer. And then you can see pretty low vacancy rates kind of across the board. Remember, I mentioned 5% is sort of that equilibrium. Most of these markets are under 5%, meaning they have some ability to grow the rents. So then if you look on the right side of the page, now we're talking about projected rent growth on the right side of that page. So 2023, 24, and 25. So we don't see double-digit rent growth. That's not, especially with interest rates growing and the economy, being made to slow down. But you do see kind of 5% through 2023. Remember, it's not a ton of new product coming out. So that's going to be a pretty good year, I think, to be in lease up next summer. It softens a little bit in 2024 and 2025, but still in general in the 3 to 4% range. So that's pretty conservative and pretty healthy, actually. So from that standpoint, obviously all of this can change. We don't have a crystal ball, but this is as close as I have as to a crystal ball in this presentation. Is here's what we think rents are going. Now, the trick is, as you know, rates have gone up, and so the rents are not able to keep up with the rates, and that's why we're seeing some downward pressure on values right now. So let's go to the next screen, and this one is showing Snohomish and Pierce County. So I promised I'd show it to you. So here, so this just gives you a little bit of an idea of the difference, and you see a little bit higher vacancy rates. Not surprising, outside of kind of an economic employment core, you tend to see slightly higher vacancy rates, and you can see fairly similar, kind of that 5% range in 2023, and then moving to 2024, 2025, kind of that 4 and 3% rent growth. A little bit softer if you kind of notice 2025, then 2024. I think that is kind of the employment and the rental demand returning to the urban cores. That's my theory. And so you kind of see that flipped for like Seattle, for example. Okay, so next slide. Now we'll get into a little bit about the rent per unit and rent growth. We've talked a little bit about this, and so it's sort of like, what are the projections? So I gave you kind of a micro view just now, and this is sort of the macro view back to the MSA level. And we can see the effective rent kind of continuing to grow, which is the green line there. And then we also see the rent growth kind of dipping in 2023. We talked about that. And then basically starting to kind of move back up over, at the end of 2023, 2024, and sort of evening out. Okay, so next slide. All right, now we're kind of moving into the valuation and sale metrics. So we've talked a lot about the rental market. Now I'll kind of go into what I talk about a lot, which is what's happening in the sale market, right? What's happening with the sales of apartment buildings right now. And what we saw in orange here is the sale volume. And you saw a huge run up at the end of 2019. That was basically the change in excise tax structure. A bunch of people sold their building to save their property tax at the end, or the excise tax at the end of the year. And then we expected to see a little bit of a hangover and drop in volume in 2020, and boy did we. Basically volumes plummeted in 2020. Halfway through 2021, things started to kind of come back a little bit. You can see the second 2 quarters of 2021 were like gangbusters, because rents were flying up, and so were we were still in a super low financing interest rate environment. So this time last year, rates were about 3.5%. Now they're probably 6.5%. So it's moved quickly. And so then we're seeing kind of that topped out of volume again in orange, and then you can see it kind of dropping from in 2023. I think that we're going to see 2022 end of this year. I think we're going to see volumes are going to be down. And that really is just simply due to the change in interest rates. And so then the other thing in blue is you can start to see a slight dip in price per unit, right? Which is essentially what are people paying, per square foot or per unit for property. And you can see a little bit of manifestation of a softening in price per unit. And you can see in green that price per unit, and then price per unit for the United States, you can see that's a little bit more even. So from that standpoint, that's starting to show a little softness in the market. We'll go back to go to the next slide, and now we'll talk about cap rates. So as a reminder, a cap rate is the ratio between the price paid for a property and the income that it earns. And so this is what always kind of confuses investors, is the lower the cap rate, the better for the seller and not for the buyer. The higher the cap rate, better for the buyer. So what we're better meaning a higher ratio of income coming from the price that they paid for the property. So with the cost of debt on the rise, what you're seeing is upward pressure on what was an extremely low cap rate environment. And so you can see that kind of holding steady, but we're starting to see a little bit of an increase in cap rates. It's not a very exciting slide, but you can see how they really came down. And now they're starting to kind of even out and flatten out going forward. So my sense is, if you've got a building and you're trying to maintain the value, the biggest thing that you can do is maintain the income. That shouldn't be rocket science, because these are income generating investment assets. That's what they're supposed to do. But sometimes in the process of operating the building and just trying to keep the tenants happy and the maintenance under control and all of that, you forget that this is actually why people buy and sell these properties, right? It's for the income stream. So the better that people can do at continuing to raise rents and move them and keep them close to market rates, that's going to preserve the value of their properties, regardless of kind of what's going on at a macro level in the market. So let's see, why don't we go to the next slide? I'm going to shift gears a little bit here and talk about the regulatory environment. And I think there's going to be a recording that will be sent out on this. So if you want kind of the detail, I'm not going to kind of read the slide to you, but there are a couple of programs that I think are important to mention. At a high level, the regulatory environment is probably one of our biggest headwinds. People love the Seattle market and the region in general. And there are some headwinds as it relates to the regulatory environment that does cause pause for investors. Now, interestingly, there are other jurisdictions that are worse, like LA, San Francisco, Portland. And so those investors tend to call us and ask about what's happening in the market. And for them, the reference point is this: our regulatory environment is not quite as bad. So that's a good thing, because when you look at these all by themselves, or you remember how simple running property used to be, it's just a little bit of a reference point that it's actually more challenging in some other markets. That said, the eviction resolution pilot program, this has been a pretty challenging sort of process for owners who have property that have a non-tenant, and they kind of have to go through this whole rigmarole through these eviction resolution pilot program centers, the dispute resolution centers, to basically handle their evictions. So there's this whole new process. Even though we already had one, we have a new one. And the feedback that I have gotten is that it's pretty frustrating because the process is not streamlined. It's been taking a really long time. Obviously, there was an eviction ban in place for a long time, but I still know owners that had tenants from before the pandemic that still can't get these tenants out. And so that's really, really challenging. And the process takes a long time. From start to finish, it doesn't tend to be very clear or consistent for residents or housing providers. So it's caused a lot of frustration. And that lack of the ability to really, if you've got kind of a problem tenant that's disturbing the other tenants, not being able to get them out has really been a very frustrating situation. So my hope is that this, kind of evens out a little bit and gets better, but that's one thing that's kind of newer and probably not working all that well. So I just thought I would mention it. The other thing that's kind of a growing concern is this coalition of housing. It's called RHA. And the original idea was, to create kind of preserving and increasing the supply of affordable housing. And they actually administer the multifamily tax exemption program. So on that hand, that is a positive program. The challenge is you've got all these different cities that are involved, and they're all starting to adopt their own version of this initiative, which was essentially to provide affordable housing. And so instead of it being kind of one cohesive set of housing regulations, now each of the cities kind of took that model and are tweaking it in their own jurisdiction. So this is a little bit crazy making for not only operators who own in multiple markets, but the attorneys that are trying to help their clients comply with some of these, or even property management companies that need to execute on the compliance of some of these regulations. So this one's another one that is just, we're kind of watching it, and it's like not looking good with the way that there's not going to be parity across many of these jurisdictions, and that's just going to make operations that much more difficult. So just thought I'd mention that. Okay, so these are specific to City of Seattle, and I'm assuming most of you know about these, but they're important to mention because I've had a couple people not know that this is going on. So we do have a 6-month notice of rent increase requirement in the City of Seattle, and it is increasingly important to recognize and track when those notices would need to be put out, because you have to think about it 6 months in advance. And so, for example, if you are wanting to raise rents next, June, July, you need to be thinking about it this month. So just kind of a heads up on that is, it's just saying you've got to get a notice out that there will be a rent increase. You don't have to commit to how much it's going to be necessarily, but if it is 10% or over, there's a whole additional set of notice requirements that include like going to the post office and getting a certified letter and some of this other stuff. So from a implementation standpoint, the current requirement just creates a little bit more work for the landlord to be able to raise rent over 10%. So it's not rent control per se, but it's actually encouraged a lot of landlords to say, okay, every year it's going to be 9.9%, right? And so, and now they're marking their calendars, because not doing that it affects how that building can keep up with market rents, and ultimately, like I mentioned before, the value of the properties, right? Because you can't just move them overnight now, which is challenging. So okay, so then tenant relocation, this is another ordinance that went into place this summer, and basically requires if a tenant that is at or below the 80% AMI, and I've got the link in here so you can see what level you are depending on where the property is. that you would need to pay. If they said I had to move because of increase in housing costs, then you would be required to pay 3 months relocation. You pay that to the city, and then the tenant actually gets reimbursed by the city. So that's just sort of interesting that the city is an intermediary there. And that, importantly, that includes rent, parking, utilities, pet fees, all of it. So you have to look at the total rent cost, not just like what my base rent is, but I'm going to start charging back for utilities as an example. That's where you can get stuck. So just recognize that it's the total rent, the rent cost. And then, and like I said, that's sort of over 10% now. There's additional language regarding any rent increases there. So just wanted to mention those couple of things because those tend to be sticking points for people that I'm talking to. All right, and then a couple additional points on the next slide. So with evictions, I mentioned that the dispute resolution centers and this sort of whole new process. I just want to make the point here that it is now more important than ever to hire professional, legal advice to move through if you do unfortunately have some kind of eviction that you need to do. Hiring a professional to help you with that, because it is very specific processes. There tend to be jurisdiction layovers. And so, like I mentioned with ARCH, right, we've got different jurisdictions with different laws. So there's the Washington state regulations, there's the King County, as an example, King County, and then specifically Seattle. So not all of those regulations are laying over perfectly with each other. So that's why, again, it's really important that you get kind of legal representation to help you through the process, because if any step is skipped, you basically go back to the beginning. So right now, that process, remember I was mentioning it takes a long time. It's been about 2 to 3 months to just get the letter of a legal detainer, and then another several weeks, I think about 6 weeks, in order to get the sheriff to post the notice and do a physical eviction. So they're just really backed up, and they're not looking to hurry up on that point. So it can happen, but you really have to stay on top of it. And again, I really recommend having legal advice on that, on now more than ever on that point. Okay, enough on that. Leases. I was just going to touch on the last little bit on the previous slide. Leases are now more critical than ever, making sure that you have the current leases. RHA has a great set of leases and addenda that all relate to kind of the requirements for Washington state, and then also the county and city requirements. So I sometimes see leases on buildings that are really outdated or don't have those different requirements. Like there was a new tenant handbook that came out probably just a year ago now, but that's something, if you don't do a lease all the time, you're going to miss that. And it's required every year to give the tenant, I believe, a physical copy of that pamphlet. So that's something that, again, not everybody kind of clues into if they're not doing it that often. So doing that, making sure that you have addenda. The other piece, and this, I see this on the sales side, is making sure that you have your move-in inspection reports, because that ties to your security deposit return. If you don't have a move-in inspection, there's no way that you can prove that there was any damage, and then you automatically have to return the entire security deposit. In addition, the reason I kind of mention it is that's something that buyers really want to see, because if you're transferring the security deposits to them and then they don't have the move-in inspection, they have to give back the whole deposit upon move out. So if you think about your role as an owner, as how, if you're deciding to make changes and sell the property, which is, again, when I talk to people a lot, thinking about how you're handing over the asset and the paperwork related to the leases on the building and all of that is more and more important to getting kind of the price and the value that you want, because some of these things, if not done correctly, impact the future buyer. So and ultimately the price that they're willing to pay for the property. So those are just a couple notes that I see when I'm kind of in the middle of working through a transaction. The next page is just talking about some resources that are out there. This is just Seattle ordinances, and then also some assistance programs. I know that there were a lot of programs over the last few years to help landlords help their tenants and things like that. So I like to include these here. And again, these are links that you can follow to get more information. All right, so going forward, next slide, we've got a couple of things. We kind of touched on these, but I think now is the time to be paying attention. You know, value is probably taking a little bit of a short-term hit. Long-term outlook is still very positive. But again, doing those things at the fundamental property operations level is going to help maintain value for your asset. And then also, you know, I just always advocate for taking good care of your tenants. They're your customers. And the better we all do, that you know, there can't be a cases made for additional regulation. So that's just it. It sort of benefits all parties if you really think of the role that you have as one of customer service. And then, you know, there's an advocacy piece that's really important, and RHA does a great job with its partners to advocate on the behalf of housing providers. And so I really like to support RHA because they are doing this advocacy work that's so important to our industry. And then we'll kind of wrap up on this going forward slide. These are just some things that when I'm looking at this landscape that really is changing, where there's some opportunities and just some advice kind of going into this sort of changing market. You know, embracing that uncertainty, I think, is healthy, and figuring out ways to solve whether it's a tenant's challenges with something or operational issues, and trying to have sort of a creative approach. I know that right now, as brokers, we're really looking at different ways to you know, have sort of financing options that might not be conventional financing because rates have gone up so much. And so we've been looking at all sorts of creative ideas with seller financing, looking at even master leases for sales. That's kind of an interesting new one that we've been looking at. Finding different structures that solve the problem for both, you know, buyer and seller, right? And the big problem right now is prevailing interest rates. And so then cash is king. With these rising interest rates, it's really an opportunity for people that are sitting on cash. I see some really nice properties coming to market. And if you're not having to kind of, you know, get the maximum loan dollars possible, and you can kind of be your own bank, there's some benefit in being in that position. And then, you know, being a contrarian, I always think this is important when it comes to real estate investing, because investors have to kind of, you know, jog when, you know, the whole market's doing one thing. Doing something else may be where the opportunity really is. And so I think there's going to be a lot of opportunities, and but investors have to kind of think about what is happening in this moment right now, but where am I going to be in 3 and 5 years? And the reason I asked, you know, kind of mentioned that is I'm sort of getting into number 5 here, but it's, you know, these are longer term investments. They're not the next 6 months, the next year. These are 5 to 10 year hold periods. And so, you know, from that standpoint, really focusing on the what you think is going to be of value long term, and what markets and why. You know, light rail is an obvious story. You know, urban centers, you know, employment, obvious story. So what are the things that you know about kind of your micro market that is proving to be an opportunity? So that contrarian kind of plays into that, playing the long game plays into that. And then, you know, the other side of it is if we have a lot of opportunity in the marketplace and you're holding on to an asset that maybe doesn't have for you that opportunity, it might be time to reposition that asset. And so, really looking at what your return on equity is, right? I mean, you may have a highly appreciated asset, but then you're making 2% on your actual equity. You can be making more in a bank account, in any kind of sort of investment, short-term investment in the market. And by the way, with rental property, it's also your part-time job. So sometimes, even if you're not getting the top of the market, if you're releasing a part-time job that isn't worth your time, that may be a reason to make changes. So, even when we see a little bit of softening in values, there can still be a big case to be made that you could be doing better elsewhere. And that's really kind of speaking to opportunity cost. So those are just some thoughts as we sort of head into a little bit of a wild ride this next year. What questions can I answer? This is sort of keeping the conversation going and sort of some next steps and folks that you can reach out to. But I'm happy to kind of open it up to a Q&A session. And I think, Denise, you're on mute.
Yes, I was on mute. Yeah, we didn't get a lot of questions. I'm curious, maybe just raise of hands. How many of you do own one or more commercial building that's 5 or more units currently?
Can you see the?
Yeah, so we have one hand raised so far, 2.
Okay.
And we had, although we always have a lot of people sign up for these classes, a lot of them don't plan on attending live, but are attending or, watching the recording later.
Right.
But so per kind of our general demographics for RHA, the majority of our members are owning single family homes or four or less units. So they're in the residential real estate kind of arena. However, so maybe you could tell us a little bit about, even though your focus is commercial real estate, we talked a little bit about single family homes early, but can you say anything else about maybe those smaller buildings, the duplexes, triplexes?
Sure. So, and it's true that we probably focus on 5 to 50 units in the city. Over the course of my career, I've sold a lot of kind of 2 to 4 unit buildings. I kind of love them because they are a great, step up from kind of the rental house or combining households and having 2 houses and renting one out or something like that. There's a lot of opportunity with the 2 to 4 unit buildings and also with single family, where you can figure out ways to maybe use it a little bit yourself or rent it out. And the other thing that I'm seeing a lot is kind of Airbnb opportunities within buying call it a duplex or a triplex, and then maybe you live in one unit, you Airbnb one unit, and you have one that's a long-term rental. So there's some rental regulations that have come in for Airbnb, but I think it has a place for certain properties, and it's kind of an interesting type of asset class. And we see a lot of opportunity. That one of the challenges is, you've got more turnover. You've got to kind of dial in the operational, like who's going to change the sheets as between the reservations and things like that. But in general, depending on location, that can be you can exceed what you would have made on an annual basis with those short-term rentals. And so kind of running the numbers on those to see, what the holistic solution looks like, I think is a way that those types of investments can be really strong. The other thing I really like about kind of that 2 to 4 unit space is they tend to be kind of tucked up into the neighborhoods. So you don't have you're just offering a different product out to the market. You're not competing necessarily head to head with like a high rise apartment, so it's kind of a different set of tenants and tends to be, a nice combination to work with. And I've owned single family rentals and small multifamily myself. and used to live in the same triplex and had an organic garden in the back, and our tenants would be out there doing the strawberries and we're doing the tomatoes and what have you. So, those days are not necessarily over, but certainly the regulation has been kind of a headwind. And so, using the RHA to get educated on what the requirements are, or having a relationship with a property management company so that at least you feel like you're directionally correct with the regulation piece, then you can confidently go through and look at, looking at maybe a building that was owned for a long time and has some rehab or construction opportunities, or adding a unit within, on the footprint of the property or within the property itself. In some cases, you can take a 2 to 4 unit building, and it used to be single family. This is something I did, and converting it back to single family, because in that neighborhood, that's the highest and best use, as opposed to a small multifamily. So what I like is there's normally a lot of different options. Even, looking at some of the turn of the century buildings that have side by side, like they might have a 2 doors, one goes up and one's on the main floor. You can, look at even making a condo out of that and selling them as condos. So there's just a lot of there's a lot of flexibility, which I like, right? You even see, families saying, okay, I'm going to live in this unit and my, parents are going to live here, right? And there's different ways to invest in real estate that isn't just all investment, right? And then it has to work kind of holistically for you, depending on where you live, where your, maybe your kids go to school. There's a lot of different elements to investing in real estate, and there's the returns, but then there's sort of the lifestyle picture, right? What if you're a high wage earner, you don't want to be running the property, and you live in Snohomish and you're down in Puyallup worrying about this toilet. So those are the kinds of things with smaller rentals that I think you really have to think about. How am I going to be the person to run this property? Or can I, make enough money on the building to have some leasing or management help? And those are some of the considerations. Like I said, it's when you only have a couple, I mean, it's an unpaid part-time job, right? So
yeah.
Make sure that you think through, it may be a great deal, but if it's way far away and you can't get there, and then you've got frustrated tenants and stuff like that, that's not going to be what you set out for.
So we do have a couple other questions now that have come in. So Brogan is asking, do you think Seattle City Council will lighten up and get worse for small rentals?
Well, I do like the direction that I see things heading in general. I like that, we had it's great. I think Bruce Harrell is doing a good job. We've got Sarah Nelson on the council that is, very pro-business, and I think is moving to, to kind of change the nature of the council. I think the council is recognizing that maybe this isn't working really very well, and there's a lot of frustration around crime and homelessness and these things in Seattle. So I think that those are factors that are going to start shifting the tide. I believe in our city. I live in Queen Anne. I love this market, and so I want to see things cleaning up. Now, the other thing that, again, looking forward, looking into the future, which is when we're owning something for 5 to 10 years, we need to be looking into the future. We've got the waterfronts coming. We've got, definitely still kind of working on getting people back to work downtown. But nightlife, restaurants, these things are really come back in the downtown market. So all that's to say, I feel good about the future for Seattle, even though I know on the day-to-day basis it's frustrating with the regulatory environment.
Yeah, one of the things that a lot of people are not aware of, although they don't have a lot of carve-outs for kind of the small owner specifically, or people owning single family homes or up to fourplexes, but they do have a lot of carve outs for owners that are sharing a single family home property with a renter. whether it's an ADU or a DADU or even a room rental or what have you. And it's amazing how many members we have that have questions about that and are in that situation. So you definitely want to make sure you're taking advantage of all of those carve outs. I'm trying to get them to publish it as like an attachment that one of those owners can attach to the renter's handbook, because half of the handbook doesn't apply to you, basically. I mean, it really is quite a bit that, so like first in time, the fair chance housing,
Right.
the roommate ordinance. I mean, there's a whole bunch of them that don't apply to you if you're in that situation.
Yeah.
But unfortunately, they haven't expanded that out to just kind of the small owner. They don't have any really a lot of carve outs for the small owner to make the regulations easier for them.
Yeah, and you know, from a cynical standpoint, it doesn't benefit them to tell people about the carve outs, right?
No, yeah.
So I think that's the hard part is, you know,
Well, yeah, but you would think they'd want to say, okay, well, we need more housing, and and people renting out an ADU is kind of likely to be a low income housing option that can be, maybe more pleasant than others. And so you would think they would want to encourage people to do that. And thus being the
right.
reason for the carve
You would
outs.
think. You would think.
You would think.
Let's see. I have one question here. I'm just kind of looking at the list of questions here. It looks like one is about the moving from the Seattle market to invest in Florida. The interesting thing about any market is it has its own dynamics, right? So Florida, you might have some different concerns than you have here. Like as an example, you might have earthquake concerns here and hurricane concerns in Florida, right? So, generally speaking, I think those are just the things to think about when you're looking at different markets. What are the drivers in those markets? Where are the jobs coming from? Why would somebody choose to live in this place versus somewhere else in that micro market? And, as an example, Lee & Associates is a national company and we have brokers all over the country. And I'm thankful for that because, to pretend like I know what's going on in a micro market in Florida is kind of silly, right? I really know what's going on in the city of Seattle. But I would want to work with a professional that focused on a particular market that I was interested in, and not just Florida. I mean, I'm talking like what part of Miami or whatever, what part of this market, because really rentals, that is a micro market. And I've mentioned that term a couple of times, but what I mean is like, if you know Green Lake and Tangletown, that's a micro market, right? You've got a little coffee shop there, you've got a couple cute restaurants, right? So people want to be in that little cluster. And so that's just something to think about. It's a concept more than sort of a term to be defined. I'm just trying to paint that picture for you. And then I see a question from my friend Scott about full rent control and impact on values. I think that, nationally, we're probably heading in the direction of some kind of rent control. And I say nationally in terms of in each state, we are seeing that trend going towards rent control, even though from an economically, ask any economist, they know it's a terrible idea. Generally speaking, we're just hearing more and more about that in concept. And I feel like what we have in Seattle is it's like rent control light. It's not rent control, but you can't raise your rents over 10% unless you go down to the post office with your certified letter and get a stamp on the letter. That's how you would have to do that. So those are ways of making it more difficult to do rent increases, which is why we're seeing more professional property management in the marketplace, which, by the way, adds cost to housing, right? We were just talking about that the other day. So from that standpoint, we are definitely seeing that on a national level. So for Washington State, rent control is incredibly unpopular at the state level, and we expect to see it again in Olympia, but we don't expect it to have traction. So again, I think City of Seattle is trying to kind of make up their own rules on a certain point. But for Washington State, rent control is not legal. It's not legal. So there was a preemptive initiative to ban to ban rent control in the state of Washington a number of years ago. So from that standpoint, I don't expect it to be coming very soon. I don't think it's going to be a benefit, because getting back to Scott's question about values, if you think of like San Francisco or Portland as markets that do have rent control, ultimately the properties are still, have strong values. New York as well, right? DC also. They still have strong values, but it puts a governor on the rental upside, or the degree in which that investment is gonna offer big returns.
And doesn't it dampen production and development of new housing?
It does. I mean, I think that the challenge with the whole conversation is, if there isn't a financial incentive to put additional dollars into an asset to bring it up to speed, because now you can rent it for a little bit more, why do it?
Right.
And so I think that and we see that also on the development side, where it used to be, if you had a parcel of land, it would take you maybe 12-18 months, and you could have an apartment building sitting on that parcel of land. Right now, with the entitlement process and construction, also construction costs, it takes 4 to 5 years to build an apartment building now, right? From soup to nuts.
Right.
And so you've got to have a pretty long timeline, and the developer isn't going to take that risk if there's not enough in the way of returns for them. And the returns are, what is the future income of that property, right? So it is challenging to and that's why we see a lot more large construction projects, because you need to have that many units to make all the numbers work. Otherwise, you're just not going to do it.
Makes sense.
Mm-hmm.
And then Tatiana is also asking, how do you find information about micro markets in preparation to invest in a new area? Remember, she had asked earlier on about moving into Florida.
Yeah.
Would an organization like CoStar provide that level of data, or do you have to dig a little deeper?
I think that CoStar is a great national source for sort of national real estate information. I don't think it's the best source for really specific finite information about, a market or a micro market. So how to find that information? I think you should get a couple tickets and fly to Florida, especially this time of year. Let's go to Florida. Yeah. So from that standpoint, I'm only half joking. I mean, really getting boots on the ground in a market is how you learn about that micro market. It's how you learn. Like, I remember when I first moved to Seattle, I went to, in Queen Anne, Queen Anne Avenue in Boston. And I went to that intersection and I was like, there's something here, right? And I think by that same token, Tangletown, Columbia City, right there, these places where there's a sense of place that people are attracted to, that renters are attracted to, that people are attracted to being. And so looking in markets for that sense of place is how you buy an investment that's not just going to have something go in next door that kind of puts you, at a disadvantage. So looking at, again, what are the drivers? Is there a university nearby? That if you're near a university and enrollment is pretty steady, probably going to be pretty good. Like the university district, as an example, has been a very consistent market for years, with the exception of 2020, when the university was closed to in-school students, right? Or in-class, in-person students. And so that was the first challenge in, call it 30 years, for a lot of investors in that market, because it changed everything. But looking for reasons why a particular market has solid job growth, employment base, like a baseline, and then growth. Those are ways that you can determine positive markets in which to invest.
Great.
Yeah.
I don't see any other questions in this moment, and it's fine if we wrap up a little bit early, I think. But if you have any other questions, go ahead and type it in real quick while we wrap up here. We do have this class available as a recording for all of you who registered. You can have access to it for the next 30 days, and then it will be transferred over to our on-demand library where subscribers can watch. I think we have close to 120 different classes available in our on-demand library right now. And we're constantly updating them. So for instance, Candice did a class just like this, but with all different data, I think about a year ago. And so we'll be updating that class. We need to get back to where we're maybe doing them a little bit more frequently. Although I know things kind of maybe were up in the air for the last couple of years, but now that we have some traction and things are happening, I think it'll be nice to get those updates as things start changing and growing again.
Yeah.
So thanks so much for your time, Candice. We really appreciate it as always. And we look forward to seeing everyone again real soon.
Thanks, Denise.
Thank you.